Some jitters have been creeping into the markets in recent sessions. We got concerns about valuations, some other risks. How should investors be approaching portfolio positioning heading into the end of the year? Joining us now to discuss is Christian Medeiros, VP and Portfolio Manager for Asset Allocation with TD Asset Management. Christian, welcome back to the program.
Thanks, Greg.
All right, so we got a bit of a rally today on our hands, but it has been choppy, and there are some concerns out there. Valuation seems to be first and foremost. How should we think about this?
Yeah, my favorite quote on valuations from Stanley Druckenmiller. He said, valuations are not a timing tool. They're something that lets you know how far markets can go once a catalyst comes in to change the market perception or direction. So in this case, with artificial intelligence, valuations are relatively high for a lot of these companies. There's a lot of expectations baked in about what AI can do for the economy. And so whenever information comes to the fore and market perceptions about the future of AI, the future of CapEx spending, how much money can be made off of this trend start to be called into question, we will see market drawdowns and market jitters. So since the end of October into early November, we've seen about a couple percent to about 5% drawdown in major indices and maybe a 10% drawdown plus drawdown in AI indices from peak to trough. And the reason being is just after big tech earnings, there's a couple question marks that were raised about the future of AI CapEx. They're still spending hundreds of billions of dollars a year on AI CapEx, but maybe investors are starting to ask, will this start to erode margins? When will we make money on these investments? They're starting to wonder that, hey, you guys are starting to issue debt to maybe fund these CapEx plans. There's a lot of private equity and private credit involved in funding these CapEx plans. Some questions are starting to be raised about AI, and when that happens, we will see a bit of a contraction due to valuations. So I think it's something for investors to be really wary of, that a lot of your portfolio, a lot of indices could be really tracking the AI trade. And when you have jitters like this, it's a good time to question and ask yourself, is my portfolio really properly diversified and set up in case things don't go well in this trend?
One of the interesting questions that have been raised lately about the AI trade is it becoming a bit of a circular ecosystem where the chip maker, sells to the AI firm in turn invests in the chip maker, and people are starting to wonder it's getting a little too cozy.
Mm-hmm. Yeah, these are some of the concerns that investors are raising. We saw in the Meta earnings call that they've partnered with Blue Owl, like a private credit shop, to help fund the AI data centers that they're building out. We've seen OpenAI enter into a lot of partnerships with hyperscalers and semi companies. So the ecosystem is there, and there's a lot more credit that's being involved into the picture, a lot of special purpose entities. Just so much money is required to fund these data centers. That's no longer just a side project that these major companies can use their free cash flow to fund. There's a lot more capital that's being brought to bear to meet such high CapEx demands. And when we get into a period of more mass financialization, chasing a huge capital program, we start to get to a point, at some point, we don't know when we might overbuild capital. And then investors will start to ask questions about profitability, whether we built out too much. And when that happens, that tends to be when you have a valuation correction. And we've seen this in the past, whether it be the railroad bubbles 100 years ago, whether it be the dot-com period in the early 2000s. So not saying that we're there yet, but at some point, we'll get to a position where we've overspent potentially on the infrastructure for AI, and then investors will ask questions, and that will affect valuations for these companies.
So as the AI side of the equity trade, of course, investors look towards the central banks, trying to figure out what the Fed may or may not get up to at its next turn. How important is central bank policy right now?
Yeah, it's very important. I think especially, and there's divergences around the world, but if we look at the US central bank has been a little bit more concerned about labor. Of course, we haven't had any data updates for a few months now, or a month now, so we don't know where labor is trending. But as they see labor potentially weakening, that deems that the market deserves a bit more support. The central bank also believes that inflation is at okay levels, not particularly concerning. And so the US Central Bank, Federal Reserve has been projecting, and the market has been projecting for them, a number of interest rate cuts going through next year. And so that's going to provide some support to the market, especially for segments of the economy that are more cyclical and tied to interest rates, whether that be small caps, whether that be some lower end consumers. So it is going to be supportive over the course of the year if those interest rate cuts do play out.
Will those lower rates be enough for people to forget about everything else they're concerned about the AI trade? How closely are those two trades linked right now?
Yeah, because it's so capital intensive right now in the AI trade, lower interest rates are supportive. It allows companies across the whole AI spectrum, which is quite large. It could be power, chips, hyperscalers. It does support incremental capital spending, but I don't think lower rates in and of themselves will change the picture if people do get extremely concerned about the future of AI.
So what should people be thinking about? I mean, I was walking up to the train this morning. It was snowing. I mean, it's not impossible to snow in November, a little earlier than we might have wanted. That really gets me thinking about, okay, we're definitely coming near to the end of the year if I'm walking in the snow to get to work. How should we be thinking about asset allocation as we draw close to 2025 and head into 26?
Yeah, great question. I think maybe three factors we can watch. One is policy support, which is still broadly supportive. I mentioned that a lot of cuts are expected from the Federal Reserve. I'd also note that a lot of the fiscal policy benefits in the US from One Big Beautiful Bill really kick in the first quarter next year during tax season. That's when consumers will see the tax rebates paid back to them. That's when companies will continue to see the benefits from accelerated depreciation. So that's a boost to the start of next year. And then we also continue to see an economy that continues to chug along at decent levels. And so if labor doesn't deteriorate, it just continues to hobble along at the current pace. It's likely that the U.S. economy will avoid a recession for the near future, and that's going to be supportive for most risk assets. So when we think about asset allocation as a whole, still warrants being moderately overweight equities and potentially, especially in Canada, maybe neutral to underweight fixed income. Then also continuing to look for alternative sources of diversification in the portfolio where it's appropriate.
I was going to ask you, where does Canada fit into all this? Because it's not been a bad year for the TSX Composite Index either.
Yeah, like a great chart that we like to look at is that the TSX has not only outperformed U.S. equities, but it's also Canadian banks have performed in line with Mag 7 over the recent period. So Canada's done extremely well. I think Canada has a nuanced picture compared to the U.S. There was very dour expectations for the Canadian economy going into this year, but the economy has done a little bit better than expected. And we've also had a huge change in policy outlook, where the government is clearly, the current administration in Canada, is much more pro-growth in outlook. They pursued a lot of supply-side easing in their recent budget, deregulating, helping to allow for more investment in infrastructure. And this should all be supportive for economic growth next year. At the same time, the central bank is now on pause. They cut more and faster than the Federal Reserve in the US, and we're at fairly low levels of interest rates in Canada. So we're having also a lot of policy support in Canada. This will probably support the Canadian equity market, especially if growth is a little bit better. But on the fixed income side, I think we're a little bit more cautious on Canadian fixed income, just given that rates are at a low level. The central bank has said that they're on pause, and we do expect growth to potentially pick up into next year on the asset allocation side. So for us, Canadian fixed income is a little bit less attractive, but Canadian equities still remain attractive in an improving growth scenario.